Welcome students. In the process of learning about the financial estimates and projections, now we'll have the next thing we will discuss here is the cash flow statement, that projection about the cash flow position of the firm. So projection of the cash flow position of the firm is another important requirement, and is another important consideration. And I told you sometime in the past that from 97 onwards, after the introduction of AS3 by the Institute of Chartered Accountants of India, cash flow statement has become very important third statutory statement to be prepared by the Indian corporates, apart from the maybe this your income statement and balance sheet. So this has become, cash flow statement has become a very important statement, third important statement. It has got the statutory status now. So we have to prepare the three projected statements. One is the income statement we discussed at length, second one is the cash flow statement, and third one is the balance sheet. All these three projected statements are required to be presented to the investors by the promoters or by the entrepreneurs, so that the investors or potential investors have the clear picture about the profitability of the firm or the project, as well as the cash position of the firm or the venture and the financial position of the venture which is going to be funded or proposed to be funded by them. So cash flow statement is the second important statement which depicts the overall cash position of the firm. So what is the purpose of preparing the cash flow statement? The purpose of preparing the cash flow statement is that the profit which is given to us by the income statement, by the profit and loss account, that is normally you call it as nominal in nature. That's not real. That is a nominal in nature. That's not the real profit, because profit is nominal and cash is real. So this is the profit. Profit is nominal and cash is the real. So we want to see, because we are not going to run the show with the profit. We are to require the cash for running the show, or maybe for say paying the expenses of the firm, or maybe for doing the business, or maybe any kind of the business dealings. We require the cash. Profit will not serve the purpose. So the income statement is going to give us the profit only, because you have seen that on the credit side we put the sales and on the debit side we put all expenses. So sales are the total sales. And for example, the total ratio between the cash and credit sales is, say for example, you talk about the 80 and 20%, right? So 80% of the sales are on credit and 20% of the sales are on cash. It means the profit coming out of this venture is going to be, it means 80% of the profit is on credit, right? 80% of the profit is also on the credit and only 20% of the profit is on cash. So it means it's going to be a very dangerous situation for the investors, that you are manufacturing, you are selling in the market, but 80% of the production is going to the market on credit basis, only 20% of the production is going on cash. You are showing that you are going to be a profit making firm, but where is the cash? Only 20% of the cash would be available with you, and if you are going to run the show with the 20% of the cash, so how would you fund the firm's operations for the subsequent periods? So they want to be very clear about it. Earlier also, when International Accounting Standard Committee in the late 90s, when they introduced the concept of the cash flow statement, and that was followed by the National Institutes of the Certified Public Accountants, like in India, Institute of the Chartered Accountants in 1997, they necessitated this statement to be prepared along with the income statement and balance sheet, and they issued the AS3, Accounting Standard 3, for preparing the cash flow statement, detailed cash flow statement. So it means they also understood that profit being nominal in nature is not communicating the real cash position to the firm. Though we have a closing cash balance in the balance sheet also. After this, you call it as a conceptual discussion in the next class, when we will prepare all these three statements ourselves. Income statement we will also prepare, projected income statement we will prepare, cash flow statement we will also prepare, balance sheet we will also prepare. There we will understand what I am talking at the moment. But everybody realized it, that income statement is giving us the profit. Profit is a nominal in nature, that's not real. And in any case, for example, if a larger part of the sales, as in this case 80% of the sales if are on credit, so 80% of the profit will also be on the credit and only 20% of the cash would be there, and that would be reflected by the bank account in the passbook and the balance sheet as well. So only with the 10-20% of the cash, how the firm can fund its operations for the subsequent operating cycles or subsequent periods. So we have to be very clear that how much profit we are going to earn, what is the profitability position of the firm, and at the same time what is the cash position of the firm. So if you are going to present them as an entrepreneur, as a promoter of any venture, if you are going to present to the investors or to the funding agencies that this is going to be our profit position, 80% of the profit is going to be on the credit, they are not going to fund your venture because they don't want to risk their capital, and they want you to sell. Maybe you reduce the level of sales, but larger part of the sales should go to the market on cash. So that's the reason that cash flow statement is required, cash flow statement is necessitated, and it supplements the profit and loss account or the income statement, so that we are very clear about that out of the total profits you are projecting in the income statement, what part of the profit is in cash, and is the cash profit, what is the cash position of the firm, and how the firm is going to fund its subsequent operations or for the subsequent years. So when you prepare the cash flow statement, this is the process involved. Maybe these are the items involved in preparing the cash flow statement. So on the top means we have the two broad sections of the cash flow statement. First section is describing or talking about the sources of the funds, and the next section is talking about the applications of the fund, right? So first we will try to ascertain what are the sources of the cash, what are the sources of the funds, or what are the sources of the cash from where the cash is going to flow into the firm. So this is a statement talking about the inflow of the cash and outflow of the cash. When you're talking about the sources of the funds or cash, you talk about maybe it's funds or you call it as a cash, from where the cash is going to come into us. So sources of the cash are going to be, number one is the share capital. If it is a venture, for example, Opus Paints, promoted by the Aditya Birla Group, right, or a Birla Group. So it means it's already a public limited company, it's listed in the market. So maybe they are going to have the funds through the share capital, and share capital is going to become the first source of the cash, because when you will issue the shares in the market, people will subscribe to the shares, they will give you the cash and you will give the shares to them. So first source of the cash is the share capital. Then apart from that, you have the profit before taxation and interest added back, because there are certain reasons why we add back the interest, because it's a financial expense, it's not an operating expense, and we want to calculate the profit from operations, cash from the operations, then the cash from financing, and the cash from investing. Under three activities the cash flow statement is prepared. So that's why we add back the interest while calculating the income from operations, and then we subtract the interest while calculating expenses on account of the financial expenses. Depreciation also to be added back, as I showed it to you. Depreciation is also a source of the cash because it's a non-cash expense. Development rebate reserve, if we get from any source, from the government agencies or maybe from any government organization, so that will also be a source of the fund or source of the cash for us. Increase in the secured medium and long term borrowings for the project. If you raise the funds by borrowing from any source, so you will get the cash will come to you. Maybe it's a borrowed cash, we are borrowing from the market, so it's a borrowed cash, but still it's a cash and it will increase your cash balance in the bank. Other medium and long term loans, so they are also going to give you the money, cash is going to come to us, it's going to cause the inflow of the cash, so this is going to be the source of the cash. Increase unsecured loans and deposits. If any unsecured loan we are going to raise from banks, financial institutions, or from the publics by issuing the public deposits, so that is also going to be another source of the cash for us. And increase in liabilities for the deferred payments. For example, we have bought any machinery, plant, or any supplies on credit. So it means we assume that much of the cash is not immediately required to be paid to the supplier. So that cash is going to stay with us. So any credit supplies are maybe termed as inflow of the cash. Then sales of the fixed assets. At any point of time you sell any chunk of land, plant, building, machinery, or any fixed asset if you sell, not today, maybe in the subsequent years. So because this is an exhaustive cash flow statement. So initial first 2, 3, 4 years you are not selling any fixed assets, but maybe after 4 years some machine has become redundant, it's old in technology, so you want to sell that and replace it with the new machine. So when you sell it, it will give you the source of funds. Then sale of investments, any kind of investments you are going to sell, that's also going to be the source of fund to you, and any other income. So all these are the sources of the cash. So any source which is giving the cash to us, that will be included, and then total sources will be called as the total receipts, total inflows will be called as the total sources of the funds, And next part would be disposition of the funds, or maybe the applications of the funds or application of the cash. And finally, we will prepare the cash flow statement. So, for example, where the cash will go to? Capital expenditure for the project. When you acquire the land, plant, building, machinery, you will pay the cash. So, cash will flow out. Then other say normal capital expenditure other than your fixed assets. For example, you go for the vehicles, you go for the furniture, you go for any patents, copyrights. So, you will have to pay them in the cash. Increase in the working capital, for example. Increase in the working capital means other than cash. Not we are not talking about the cash component in the working capital. That is the increase of your inventory, increase of your credit sales, increase of your prepayments, or any other kind of the current assets. When current assets increase, naturally they are consuming the working capital, they are consuming the cash. So, disposition of the cash would be caused. Then decrease in the secured medium and the long term borrowings. When you pay all these loans which we have borrowed, when we borrowed the loans, cash increased. But when we are repaying it back to the source, so maybe it's say public institutions or state finance corporations or banks or anybody, when we are paying these loans back, so it means it's causing the application of the cash. So, cash balance is decreasing. Decrease in the unsecured loans and deposits. So, again it will be application of the cash. Decrease in bank borrowings for the working capital. So, you are paying it back, so it means cash will go down. Decrease in the liabilities for deferred payments, including interest to the machinery suppliers. So, naturally you are going to pay the cash. Increase in investment in the companies. So, any investment, for example, within your project or maybe some surplus funds you are investing into other companies. So, it means that will also cause the outflow of the cash, and interest on the term loans will also cause the outflow of the cash. So, it means all these outflows, inflows will be taken into account. Similarly, interest on the bank borrowings for the working capital. If you are paying any interest on the bank borrowing, your cash is going to go out. Then you call it as a taxation payment or payment on account of tax when you are paying in cash, or dividends, your cash will decrease, and any other kind of expenditure. So, total of the A and total of the B. Total of the A talks about is the inflow of the cash, total of the B talks about the say outflow of the cash, and finally we will calculate the closing cash balance, right? Closing balance of the cash, it means how would that be calculated? So, first we will have the opening balance of the cash. So, closing balance of the cash of the previous year would be the opening balance of the cash for the current year. And in the current year, for example, if your inflow is more and outflow is less, so there will be net surplus of the cash available with us. So, that will be added back into it, right? Plus we will be doing that in the opening balance plus surplus of the cash. But if it is reverse, that your outflow is more than the inflow, so you will subtract it, minus, and finally you will be calculating the closing balance of the cash, closing cash balance. So, you will have to calculate it, closing cash balance, you have to calculate it, and finally that cash balance would be helping us to understand the cash position of the firm. So, this is in nutshell, this is the just only detailing of the items to be taken into account while calculating the inflow and outflow of the cash. In the real sense, we calculate the cash flow statement under three activities. First activity are operating activities. First is the operating activities. Second one are the financing activities. Financing activities, we prepare it under three categories, and third one are the investing activities. Investing activities. So, we are preparing the cash flow statement under these three activities, so that we can find out how much cash is flowing in and flowing out on account of operations of the firm. How much cash is flowing in and flowing out on account of the financing activities of the firm, and how much cash is flowing in and flowing out on account of the investing activities of the firm, right? So, these are the three major activities which are talking about or which will be included while preparing the cash flow statement. Why we prepare this under these three activities? Just to understand that, for example, a firm is a manufacturing sector firm, right? And the closing cash balance is very positive. We have a sufficient closing cash balance. So, we want to find out what is the source of that cash. Because if it is a manufacturing sector firm, larger part of the cash must be coming to us from the operations. If it is, if the operations are giving us a negative cash balance where outflow is more than the inflow, but financing is giving us the positive balance or investing is giving us the positive balance, it means there is something fishy about this kind of the firms, because their operations have already become sick, which are consuming more cash and generating less cash. But so we should not feel happy that we have a very good closing cash balance here. We want to find out in the cash flow statement what is the source of that cash. Cash must come in a manufacturing sector firm or even in a service generating firm. What is the major business of the firm? That should be the source of the cash, and this closing cash balance largely should come from the operations, because we are neither a financing company nor an investment company. If we are an investment company, major source of the cash should be investments. If we are a financing company, major source of the cash should be the financing. But if we are a manufacturing company or a service sector company, major source of the cash should come from the operations. But for example, operations are generating negative cash and only financing or investing are giving us surplus cash. It means there is something wrong with this kind of the business. So business is not generating cash. Main operations are not generating cash, and cash is coming either from financing, which is a very dangerous situation, even from investing. This is also not a good situation, because company is neither a financing company nor an investing company. It's neither an investment company nor a finance company. So if it is a manufacturing or service rendering company, service generating company, more amount of the cash should come from these activities, operating activities. That's why we prepare the cash flow statement under the three activities these days: operating, financing and investing. And accordingly, we are putting the under operations, we are also doing the same thing. Same means first we will take into account all the sources of cash and all applications of the cash, and we will calculate the closing cash balance from the operations. A, right? This is A. So this is called as operations. Then we will go for B, right? B will be called as financing. So then we will see that on account of financing, how much cash is flowing in and how much cash is flowing out, and what is the net balance. And then we will go for C, and C is basically the investing activities. We will also calculate the individual balance, and then we will sum it up, right? O plus F plus I, right? And then we will calculate that what is the closing cash balance, and this CCB, closing cash balance, we have to calculate, which is the purpose of this cash flow statement, and we have to find out how much it is coming from operations, how much it is coming from financing, how much is coming from investing, and what is the total closing cash balance. So if it is a manufacturing sector firm or a service sector firm, more cash must come from operations rather than coming from financing or investing activities. So be careful when you prepare the projected financial statement, projected cash flow statement. Try to find out and show it practically that your operations are very, very strong or going to get stronger and stronger over the years. If you are going to give this kind of a picture to the investors, then it's fine. But if you are going to present a other picture to the investors, that operations will not be generating cash in the initial 4, 5 or 6 years, rather cash more would be coming from financing or investing, nobody would take interest to invest funds in your business. Your business will not see the light of the day. So for that purpose, you have to make sure, maybe through all the background analysis, that's the market and demand analysis, technical analysis, your production, operations, sales, everything you have to project in such a manner, and rather you have to do it in the real sense also, that your operations are getting stronger and stronger over a period of time, and you are going to maybe build a firm or a business where the operations are very strong, and larger source of the cash is going to be the operations of the firm. So this is just a conceptual discussion about the cash flow statement, even for the profitability projections. So when practically we will prepare these statements in the next class, you will understand that how we prepare the projected financial statements while going for the financial estimation and projections. And now last thing we will talk about is the balance sheet, projected balance sheet. So balance sheet is the last statement, projected balance sheet is the last statement, and in this statement we try to know about is the financial position of the firm, financial position of the business. And as I told you in some previous class also, that financial position of the firm should be balanced on the last date of accounting period. I will discuss the concept of accounting period also in the subsequent slide. So on the last date of accounting period, the balance sheet must present a picture, present a balanced view, that your assets are equal to liabilities and vice versa, or liabilities are equal to the assets. So we prepare a balance sheet a projected balance sheet for the same number of years for which you are going to prepare the income statement and cash flow statement, and normally projections for the next 7 to 10 years of the period are required. If you go for projections less than this much number of years, then your investors may not be impressed. So you have to go for minimum 10 years of the projections. So you should have all the estimates for the 10 years, next 10 years. Your market and demand estimates should be for the next 10 years. Technical requirements means the cost components should also be for the next 10 years, and your this balance sheet must also be for the next 10 years. Projected balance sheet must also be for the 10 years. So balance sheet is something like, I'll explain you with the help of the format here. So again, the balance sheet can also be prepared in the T format or in the vertical format. When you talk about the T format, it is again a T format. You're dividing it into two halves, and on the one side you are keeping liabilities and assets, liabilities and capital. On the right hand side you are putting as the assets. So when you're talking about the liabilities and capital, so we are starting with the share capital. If it is a public limited company, or maybe the investment by the promoters, that also can be called as not a share capital. In that case, you would call it as only a capital, right? And that's the first source of the funds which are coming to you or to your business. So first, initial investment, as we talked sometime in the previous classes, that for example the investment ratio is going to be, for example, 30% and 70% and 30%. So 70% is a borrowed capital, is coming from the venture capitalist, and 30% is coming from the entrepreneurs or from the promoters. So ratio between the internal and external funds is going to be 30 and 70. So capital would be 30% and the borrowed capital would be something like as 70%. So that way the sources of the funds are going to be. So balance sheet is basically a statement which on the one side is keeping all the sources from where the funds would be generated by the business, and on the right side is putting all the applications that generated funds which are shown on the liability side of the balance sheet, how they are being utilized. They will be shown in the asset side of the balance sheet, and they will be utilized for having the fixed and the current assets by the firm. Fixed assets means the life of those assets is more than 1 year, more than 12 months, and current assets whose life is less than 12 months. So they are the current assets. Fixed assets are land, plant, building machinery, furniture, vehicles, patents, copyrights, all that. Current assets are your material, credit sales, sundry debtors, then cash, then your prepaid expenses. All these are your current assets which are called as to be created by way of the working capital. So current assets are normally say divisions of the balance sheet. Upper part is called as the long term, is presenting the long term view of the business, and the lower part below this line, current liabilities and current assets are presenting the short term view of the business, means short term financial position of the business. So long term financial position and short term financial position. So long term financial position is depicted by the long term sources and the long term assets. Short term is by the short term sources and the short term assets. Short term sources are current liabilities and short term applications are short term assets or the current assets. Normally the duration or the life of the current liabilities and current assets is up to 1 year, that is 12 months. And for the long term sources and assets and liabilities, the lifespan is more than a year. So you just balance sheet means this is on the one side we are putting all the sources, and on the other side we are putting applications. So the funds are coming from this side, coming to the business are shown here on the liability and capital side, and the purpose for which they are being used, they are shown on the asset side of the balance sheet. And finally, at the end of the day, on the last date of the accounting period, this total must be equal, right? For example, if it is 100 here, so it should also be 100 here. And that has to be on the last date of the accounting period. Last date of the accounting period means there is a concept of accounting period in accounting. While preparing the financial statements, you have to select a period of 12 months. While preparing even a projected financial statements also, you have to select a period of 12 months. And that can be any period of 12 months. It can be a financial year from April to March. It can be a calendar year from January to December. It can be maybe any year from July to June. It can be from October to September. Depending upon the nature of the business, the entrepreneurs, promoters are free to select any period of 12 months, which will be called as the accounting period. And at the end of every accounting period, at the end of the every period of 12 months, you have to present the results of the business in the form of these three statements: income statement, cash flow statement and balance sheet. In the form of these three statements, you have to present it to the different stakeholders, internal as well as external stakeholders, the results of the business, that what is the profitability state of the business, what is the cash position of the business, and what is the financial position of the business. That period of 12 months, beginning with any month and ending after 12 months, is called as the accounting period, and that can be any period of 12 months which can be selected by the promoters or by the entrepreneurs themselves. Now, there is another important consideration. For example, we are writing here 31st March, and year can be any year for which you are going for projections. Why I am writing here 31st March? Because we are considering that our accounting period is the financial year. It's beginning on 1st April and it's ending on 31st March. So, for all the 10 years, you have to have this kind of the period, and on any first year, it will begin on 1st April, end on 31st March, the next year, next to next year, like that, up to next 10 years. The projected financial statements you will prepare, you will show it for those say 12 months period of time. So, you will have the 10 12 months periods, and there will be the 10 accounting periods. So, beginning with 1st April and ending on 31st March, or it can be from 1st January to 31st December, or it can be any other period of 12 months. And there is one difference also, that profit and loss account presents the state of profit or loss of the business for a period of 12 months. So, if you see the heading there, the heading given, this title given is, that is the trading and profit and loss account or income statement of, for example, a company named as XYZ Limited for a period or for the year ending on 31st March 20xxx, right? And here we have written is balance sheet of XYZ Limited as on 31st March 20xx. It means profit and loss account depicts the picture of the profitability or profit or loss of the firm for a period of 12 months, 1 year. Whereas a balance sheet depicts the picture of the financial position of the firm only on the last day of the accounting period. 1 day before the accounting period, the balance sheet may be disturbed. 1 day after the accounting period of this 31st March, balance sheet may again become disturbed. Your liabilities may be more, your assets may be less, or vice versa. But on the last date of accounting period, you have to show that your balance sheet is a balanced document and it's presenting the balanced view. So, the difference in the titles is there. That is income statement for the year ending on. It means it's presenting the total say income and expenses for the year as a whole. Total sales which you did for the whole of the year, total expenses you incurred for generating those sales for whole of the year. So, that statement is presenting you the results for the whole of the year. Whereas the balance sheet is depicting you the results only for this one particular day, last date of the accounting period. This is a very important consideration here. And these are the important financial projections, these three important statements, that is the income statement, cash flow statement and balance sheet. And like your income statement, balance sheet can also be prepared in the vertical format. Balance sheet can also be prepared in the vertical format. Rather, these days, firms are preferring more to prepare the financial statements, income statement, your cash flow statement and balance sheet more in the vertical format. So, if you go for the vertical format, almost everything is going to remain the same. On the top, you are putting the assets, which are non-current, means fixed assets, and current assets like your short-term assets, material, and then stock means inventory, then the credit sales, then prepaid expenses, cash, advance deposits, all these are the current assets. So, this will give us the total assets we are putting on the top, and then we are comparing this with the total liabilities, which are the sum total of all the sources of the finances coming to the firm. They may be long term and they may be the short term. They can be equity and capital and liabilities, borrowed. So, internal as well as the external funds. So, owned as well as the borrowed funds. So, sum total of this will become equity and liability. So, these are the sources of the say financial sources coming to the firm, and these financial sources are required for say acquiring the assets, long term as well as the current assets in the firm. So, it means this way both the sides, upper as well as the lower side, should be equal. So, for example, the total assets are 100 here, 100 rupees here, it is INR. So, the liability should also be 100 INR. So, it means it has to present a balanced view, it has to present a balanced picture. So, total assets must be equal to the total liabilities and total liabilities must be equal to the total assets. So, this side liabilities and equities the equity and liabilities, they are giving you they are presenting the picture of the total financial sources, and assets are giving you the picture of the total applications of those funds, means commitment of those funds, and how much funds you have raised from different sources. They should be justified by showing their investment in the form of different assets, that's the long term as well as the current assets. And if any amount is remains unspent, so that will be shown as a current assets, that will be shown as a current asset in the form of cash, that will be shown as current asset in the form of a cash. So either you prepare this in the T format or you prepare in the vertical format. One way, means either way it's correct, and ultimately it's going to present the balanced view of the overall financial position of the firm. So this is some conceptual discussion about the three profitability projections as well as the financial estimates or financial estimates and projections of the firms, and they are very important for the new ventures, new projects. So if you go to because without these three projected statements for the next 10 years, you cannot go to the investors or to the providers of the funds. So especially in case of the startups or for whom the other sources of the funds are not available, they have to very meticulously prepare all these three statements for the period of next 10 years, should try to have for almost the answer of every possible question, try to convince the investors that yes, our business is going to be a profitable venture because we are depicting the very clear profitability estimates, our cash position is going to be very sound, and our financial position is also going to present the balanced view. If you go with this kind of the very balanced and means meticulously prepared projected financial statements to the investors, there is no doubt that they will not give you the funding and they will support your venture. So for the moment we will stop here, and we have discussed conceptually all the financial estimates and projections, and in the next class or maybe the next class onwards, we will learn quickly to prepare, means how to prepare these three statements, how to prepare the projected income statement, projected cash flow statement and projected balance sheet. Till then, means we will stop here. Till then, thank you very much, and we will resume the discussion with the practical preparation of these projected financial statements in the next class. Thank you very much.